Hey, it's Darius, and congratulations to I-75ers who let me know that they passed the CPA exam this month. See the green check marks? That means they're done. No more CPA review for them. But what about you? Are you connecting well with the material that you're using? You can still pass. You just might need to get on the right road. Go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll save a spot for you on next month's list. Business combinations is huge on the CPA FAR and also bar exam. So in this video, we're going to take a deep dive into the so-called eliminating entry. Our focus will be where the parent buys less than 100% of the sub. So there will be accounts like non-controlling interest and goodwill, and some intangible assets that the subsidiary didn't even have on its balance sheet on the date of acquisition. And we'll do it all not with lecture, but the I-75 way, which is narrated multiple choice questions. And you've probably seen questions like this on your exam. And after this video, you will be able to recognize and attack them. So let's dive in to our first multiple choice question.
Let's try this. On January 1st, year 19, Prince Corp purchased 80% of Sasser Corp's $10 par common stock for $975,000. On this date, the carrying amount of Sasser's net assets was $1 million. The fair value of the identifiable assets and liabilities were the same as their carrying amounts, except for equipment, which were $40,000 in excess of the carrying amount, and a patent with a value of $10,000 that was not even on the balance sheet of Sasser Corp. The fair value of the 20% non-controlling interest in Sasser was properly determined to be $200,000 at the time of acquisition. Now, in a business combination accounted for as an acquisition, the journal entry to record the investment on the separate books of Prince Corp would include what? So since it's a legal acquisition, the parent's only going to have one asset, investment in subsidiary, and they're going to credit cash. And the amount will be $975,000. And how do we get that? Well, it's a cash deal. They're not issuing stock, so whatever they're paying, in this case, $975,000, will be debited to investment in subsidiary and credited to cash. Because on the parent's separate books, only the actual cost paid to acquire the investment is recorded. Fair value adjustments, non-controlling interest, goodwill, they're not recorded on the parent's separate books. They're only handled in the consolidated workpapers so that they appear on the consolidated financial statements. And the question asked about the journal entry to record the investment on the separate books of the parent, and it will be a debit to investment in subsidiary and a credit to cash for the amount paid. And that's usually the first thing to do in a business combination question, is to determine the amount paid, the cost of the acquisition on the parent's separate books, and it would be $975,000. Then we'll go on to the consolidated workpapers to determine what has to be recorded there. The whole eliminating entry. Looks like there are some undervalued assets here on the subsidiary's books, so we'll have to take all that into account before we even recognize goodwill. So same facts for this. They want to know how much is the fair value of Sasser Corp's net assets at the date of acquisition. Now, why would they ask that? Because it's the fair value of the net assets that'll help us determine if there's goodwill or a gain. We start with the book value of the net assets of the sub, and they tell us that it's the carrying amount of Sasser's net assets was $1 million. That's the book value. And then they say the fair values of the identifiable assets and liabilities were the same, except for, and there'll always be one or two, equipment was $40,000 in excess of the carrying amount. So we have undervalued equipment to write up in the amount of $40,000, and a patent with a value of $10,000 that was not even on the balance sheet of Sasser, so that wouldn't be included in this $1 million of book value. So how much is the fair value of Sasser Corp's net assets at the date of acquisition? And the answer is D, $1,050,000. Because the fair value is equal to the book value, it says, except for the undervalued equipment of $40,000 and the patent that had not previously been recorded. And this fair value of the sub's net assets of $1,050,000 is going to be needed in calculating goodwill on the date of acquisition. And that's what this question wants to know. Same facts, how much goodwill should be recognized at acquisition? Well, it looks like we paid $975,000, but this is where the non-controlling interest comes into play. Since we only bought 80%, they told us the fair value of the non-controlling interest was $200,000. So now we have to add the $200,000 to the $975,000, and that means the total amount transferred to the subsidiary is $1,175,000, and then we can compare that to the fair value of the net assets, which is $1,050,000. And when we do that, we get goodwill of $125,000, because goodwill is the difference between the fair value of the consideration given, $975,000 in cash, plus the fair value of the non-controlling interest of $200,000. So $1,175,000 minus the fair value of the sub's net assets, which we determined is $1,050,000. There's $125,000 of goodwill to recognize in the so-called eliminating entry. We already know the entry on the parent's separate books was just investment in subsidiary credit cash for $975,000. But now we're up to that eliminating entry in the consolidated workpapers. Upon acquisition, we have to eliminate the equity of the sub, which they told us the book value was $1 million. They didn't give us the separate common stock, APIC, and retained earnings. They just said the equity of the sub has a book value of $1 million. Eliminate it. Debit equity of the sub for $1 million. Now we have to write up the equipment by $40,000 and the acquired intangible of $10,000 because it's not yet on the balance sheet of the sub, and we acquire the sub assets and liabilities at fair value. So these two assets have to be brought up to fair value, and we show that with two debits on the consolidated workpapers. Because they told us the equipment is $40,000 in excess of the carrying amount, and the patent worth $10,000 was not even on the balance sheet. So we need these two debits before we recognize the goodwill. Our credits are going to be to investment in subsidiary for $975,000. That gets rid of the original entry on the parent's separate books. And then we're going to credit the non-controlling interest for $200,000. Why do we credit that? Because it's a stockholder's equity account with a normal credit balance. And the question asked, how much is the goodwill at acquisition? And the answer is $125,000, and that's choice B. And where is this goodwill going to be shown? Not on the parent's separate books, not on the sub's books, but in the consolidated workpapers so that it could make its way onto the consolidated financial statements. We call it the eliminating entry, but we see that not everything's getting eliminated. The equity of the sub's getting eliminated, and so is the investment in subsidiary getting eliminated. But here's some accounts getting created. The equipment fair value adjustment for $40,000, the acquired intangible for $10,000, that's getting created so that it appears later on the consolidated balance sheet. And the goodwill of $125,000, that's being created here so that it could appear in the consolidated balance sheet. And what about the non-controlling interest of $200,000? That's not being eliminated. That's being created here so that it can appear where? On the consolidated balance sheet in the stockholders' equity section separate from the parent's equity.
Now, obviously, there's more to business combinations, and we can do it together. All you have to do is go to i75cpareview.com and get yourself on the right road. Get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a link in the description.